Hello. I want to talk to you about a simple yet profoundly important topic. My three-pillar plan for your money in 2026. This is a plan born not of optimism or prediction, but of discipline, clear valuation, and a deep respect for the power of financial gravity. The current market is a paradox. On one hand, you have soaring stock prices driven by optimism about a few select sectors. On the other hand, my company, Berkshire Hathaway, is sitting on a massive, record-breaking pile of cash and short-term U.S. Treasury reserves, over $381 billion. This huge reserve is not an accident. It is a deliberate strategic decision. We simply cannot find truly wonderful businesses at a fair price right now. The market is expensive and risk is mispriced. If you are to successfully navigate 2026, you must align your money with three core principles: defense, quality, and discipline. My three-pillar plan is built on these principles, specifically designed to withstand the inevitable credit crunch that the current debt levels suggest. I ask you, is your portfolio built on a solid foundation, or is it balanced precariously on speculative hopes? Pillar 1, the defense pillar, high-quality, short-duration assets. The first pillar is pure defense. This is about establishing a financial fortress that preserves your purchasing power while maintaining instant, massive liquidity. For me, this is the single most attractive asset class today. This asset is the short-term U.S. Treasury security. The market is being foolishly seduced by high-risk assets when the safest asset is offering such an attractive return. This is directly due to the Federal Reserve's policy stance. Data point 4, the Federal Reserve Fed funds rate November 2025 is 5.75%. Because the Federal Reserve is keeping the cost of short-term money high to combat inflation, you can earn an excellent, virtually risk-free return, often near 4 to 5% by holding short-term U.S. Treasuries. This safe, risk-free return more than neutralizes the inflation tax, preserving your capital's purchasing power, which is the most fundamental goal of investing. Now, look at the risk versus reward mismatch in the junk bond market. Data point 5. Spread between high yield and treasury bonds, November 2025 is 350 basis points, historically tight. The market is only paying you 3.5% extra to buy junk debt, which is facing severe pressure. Why chase a tiny extra yield when the risk of principal loss is immense? You must not risk 95% of your principal for an extra 2 to 3% of return. Don't follow the crowd. The crowd is still chasing yield and will be crushed. When the corporate debt bubble, the junk bond meltdown of 2026, causes bond prices to collapse, hold the safest, most liquid asset. Hit the like button if you currently hold high-quality T-bills or T-bill funds. Comment your safe yield below. My question for you is, are you getting paid a generous, risk-free rate to be patient, or are you gambling for pennies? Pillar 2, the quality pillar, enduring businesses. The second pillar is about quality. This pillar focuses on selecting the rare types of businesses that can compound wealth and thrive regardless of the severe economic contractions that the current debt load is signaling. I am looking for businesses with durable pricing power, low capital intensity, and a fortress balance sheet. In a volatile, highly indebted economy, you need companies that are masters of their own destiny. I look for two simple characteristics: a powerful, durable, competitive moat, and a low need for constant, massive capital expenditure. They don't have to keep borrowing to survive. Data point 1, U.S. corporate debt to GDP ratio Q3 2025 is 52.8%, record high. When corporate debt is at a record high, the cost of financing that debt, coupled with slowing consumer spending, will crush the weakest companies. I want the opposite. I want businesses that can raise prices to offset rising costs. Data point 8, Consumer Confidence Index, November 2025, is 95.5, falling from 105 in Jan 2025. A fall in consumer confidence means consumers are going to cut spending, putting immense pressure on corporate revenues. The businesses that survive are the ones that sell essential, branded, or non-discretionary products and do not rely on cheap debt. When the Junk Bond Meltdown of 2026 hits, the stock prices of these wonderful businesses may temporarily fall, but their intrinsic value will be untouched, giving you the chance to buy world-class assets at a discount. Value is greater than hype. The hype is always about the next speculative story. The enduring value is in the quiet, dependable fortress business that controls its own destiny. Subscribe now to the channel and hit the bell notification for true risk signals. We must focus on the fundamentals that never change. My question for you is, does the business you own have a durable moat that protects it from falling consumer demand and high interest rates? Pillar 3, the discipline pillar, tactical credit selection. The third pillar requires discipline and a recognition of where the real risk is concentrated. This pillar focuses on making the safest tactical choice within the credit market itself. This asset is the short duration, A-rated investment grade corporate bond. While I avoid high yield bonds like the plague, I do not avoid all fixed income. Investment grade corporate bonds, particularly those from A-rated or better companies, offer a safer, higher yielding option than long-term government bonds, but with a massive safety buffer compared to junk bonds. The key is, in the selection, A-rated ensures the lowest probability of default, and short duration protects you from crippling interest rate risk. This provides a safe, predictable income stream. The reason this asset is a key part of the plan is the impending flight to safety. Data point 2, high yield bond default rate forecast for 2026 is 6.5%. As high yield defaults surge towards 6.5%, investors who hold that junk will panic, leading to a massive flow of capital into the safest debt assets. This flight to safety will create high demand for investment grade bonds, particularly those with short maturity. By owning them now, you position yourself to benefit from both the safe, generous coupon yield and the eventual price appreciation as that flood of money comes in. Data point 6, percentage of distressed high yield debt, November 2025, is 11.2%. This high percentage confirms the default wave is already starting. You must be on the quality side of this trade. Preservation of capital is priority number 1. The disciplined investor ensures their fixed income provides a predictable return with minimal risk of principal loss. Please share this video with a friend who is holding a high-yield bond fund. Help them understand the peril of their position. My question for you is, does your fixed income portfolio reflect the panic that is now starting, or is it prepared to profit from it? To summarize, your survival and growth plan for 2026 must be anchored in these 3 core assets that reflect a strategy of discipline and value. The 3 pillars are short-term T-bills for defense, low capital intensity businesses for quality, and short duration, A-rated bonds for discipline. Don't follow the crowd. The crowd will be ruined by chasing junk yields and overpaying for speculative growth. You must be prepared to be the one who steps in with liquid, high-quality capital when the corporate debt bubble, the junk bond meltdown of 2026, creates the panic. The greatest asset of all is a mind that can think clearly and independently when the world around it is panicking. You must be patient, safe, and ready to act. I ask you now to smash the like button if you are committed to high-quality assets, subscribe to the channel, and hit the bell for more warnings like this. Comment 3 pillars if you are aligning your portfolio with this plan. And please share this video to 3 friends you care about. If you want a free guide, you can get my margin of safety guide in the description below. Stay safe. God bless. My final question for you is, which of the 3 pillars will you strengthen in your portfolio over the next 30 days?